Good morning, good afternoon, and good day to you. My name is Carter Froelich, and I'm the founding member of the Property Ledger, the web-based real estate investment software for individual real estate investors. I'd like to thank Arpola for giving us the opportunity to be a service to the real estate community by presenting a number of educational videos related to financial analysis of real estate investments. The first of these that we'll be presenting is that of financial literacy and why it's important, and to the extent that the investor doesn't have this financial literacy, that they should beware. Before we get into that, let me tell you a little bit about myself. I'm a certified public accountant, licensed in the states of California and Arizona. Please don't hold that against me. We're going to try to make this fun. I'm also a former state certified real estate appraiser. I don't do that anymore, but I did. I'm currently the partner in a national real estate consulting firm. But first and foremost, I'm a real estate investor. And I've fallen in love with real estate investing ever since I was a kid, and I played my first game of Monopoly. I've been buying property since the 90s. I don't have a very sophisticated philosophy as it relates to buying property. I just buy it and hold on for the long term. And but let's jump into our topic, and that being financial literacy and why it's so important. What I'd like to show you first is a vendor pro forma that was presented in a website by a vendor who's selling real estate investments to investors, and this is on the East Coast. And this individual was selling a single-family home for $75,900. They're showing closing costs of $900, repairs of $12,000 for a total investment of $88,800. They had indicated that the income to be generated to the investor would be $12,900. Their operating expenses of property taxes, insurance, and a management fee for a net operating income of $96.41 or $9,641. That equates to a cash-on-cash return of 10.86%, which is really pretty good. For those of you who may not be familiar with cash-on-cash return, think of it in terms of a CD in a bank. If you were to take $10,000 and purchase a certificate of deposit, and at the end of the year, the bank wrote you a check for $600, that would be a 6% cash-on-cash return. And that was determined by dividing the $600 that you received by the $10,000 investment, thus a 6% cash-on-cash return. But if you look at this vendor pro forma, you might be a little suspect, because if you're educated in finance, and if you're educated in the nuance of real estate investing, you know that this vendor has left out some very important items. What are some of those items? Well, if you take a look at the bold items, you'll see that the investor left out the vacancy and credit allowance. Very rarely will you ever find, if at all, a real estate investment property that's not vacant at some point. So we need to make an allowance for the fact that at some point in time this will be vacant and won't be generating revenue. We're also going to have to pay some costs associated with that. We're going to have to pay a bookkeeper, or we're going to have to pay an accountant to do our tax returns. When that unit is vacant, we're going to have to go in and clean and repair it. During this time, we're going to have to pay for utilities. We're also going to have to remove snow or cut the grass and clean up the landscaping around the house or the unit. To the extent that we lease it, we're going to have to pay somebody a leasing commission. And then also, what we would have to do is start setting aside some money for those items that are going to wear out over time, such as appliances, roofs, HVAC, water heaters, etc. So if you go in and you revise the vendor's pro forma, you see that they're not generating the net income that the vendor was showing. We're generating something that's about 31% less than that, which in effect reduces our cash-on-cash return dramatically, or in this case by 31%. If we show the vendor scenario on the left-hand side, and we still wanted to generate that 10.86% return, given our new operating income, we could only afford to pay $48,250 for this property to still achieve the same 10.86%. So you're beginning to see why financial literacy and an understanding of of what it takes to operate a real estate investment is so important, because if you don't understand these things, you're going to be making some bad purchase decisions. So obviously the solution to that is to become educated in real estate investing. And clearly, real estate involves a lot of numbers, and you need to get up to speed on those numbers so that you can really evaluate the components of real estate return, which are cash flow, appreciation, the amortization or the pay down of the loan over time, plus all the tax benefits. And so we're really hoping that you'll continue with us in what we're calling the Property Ledger Academy to help assist you in your education over time. And to the extent that you're looking for an analytical tool, we really hope that you'll take a look at the Property Ledger. You can go to our website at thepropertyledger.com and take a look for yourself whether this will meet your investment goals. Thank you. Hello everyone, this is Carter Froelich with the Property Ledger, and welcome to today's educational seminar, What Revenue Will My Property Generate? Or Estimating the Effective Gross Income of a Rental Property. And before we get into the effective gross income, it's important to have an understanding of what the formula is for the effective gross income. And it is nothing more than the scheduled rents of the property plus the other income to be generated by that property, less the vacancy allowance, and that would equal your effective gross income. So let's take a look at the definitions of the various terms that we utilized. And the gross rent, or another word for gross rent would be the scheduled rents, are the total revenues which the property would achieve, assuming the collection of the rents of all of the occupied units as well as the vacant units achieving a current market rental for that particular property. So let's say, for instance, we have a fourplex, and of the 4 units, 3 of them are currently rented at $500 each, or generating $1,500 a month. We would assume those 3 units would continue to generate that $500 a month. The 4th unit, which is the vacant unit, for our purposes here, let's assume that the market rent for this particular unit would be $525. Well, we would use the current market rent, so our total gross scheduled rent for the particular property on a monthly basis would be 3 times 500 for the $1,500 plus the $525 for a total of $2,025 per month. Now that would be a multifamily property. And as kind of an aside and as a rule of thumb, if you're looking at purchasing a single-family home and assuming you're going to be able to finance 100% of that, which is probably not a reasonable assumption anymore, but it's for our purposes here and for discussion purposes, it's kind of a neat rule of thumb. But if you're looking at a single-family home purchase, and you should be able to achieve a rent of anywhere between 1% and 1.3% of that purchase price. So if the home were going to sell for $100,000, you need to be able to achieve a market rent of anywhere between $1,000 to $1,300 per month to have that cash flow, assuming you're going to finance 100% of the purchase price. If we take a look now at what the definition of other income is, it's just basically other income generated from other sources related to that property other than rental income, and those could include late fees charged to tenants for paying their rents late, their vending revenues, laundry revenues from coin-operated laundry, and to the extent that you're charging for storage and parking in and above that which you charge for rent, you would include those in your other income calculation as well. Now, one of the key components of this formula is the vacancy and credit allowance. Now, when you're looking at acquiring property, many times what you'll see is either a broker or a seller fudging a little bit on what the vacancy and a credit allowance is. For instance, they may say, you know what, we're going to be experiencing a 2% vacancy and credit allowance. And to the extent that that vacancy and credit allowance is small, they're going to be able to show more revenue. And if they're showing more revenue, that means the property is worth more. And given the income capitalization approach to value, therefore you're going to have to pay more for that property. And as part of your negotiations, it's going to be paramount that you're that you're up on the market and that you know what your market's vacancy and credit allowances are. So say for instance if the seller or the broker was representing a 2% vacancy and credit allowance, and you know from walking a lot of the units in the area of this property that it's really 7%, you're going to want to base your acquisition on a much higher vacancy and credit allowance, in this case 7%, and you're going to want to be able to demonstrate to the seller that it is in fact 7%. And if you're able to bring down that or bring up the vacancy and credit allowance, you're bringing down the revenue, which brings down the purchase price, which makes you purchase that property at a much lower price. And obviously, you only want to pay a fair price for that property. And so, really, the rule of thumb is you want to use the vacancy rate, which is reflective of the property and or the market in which that property is located. So if we take a look at the effective gross income again, it's nothing more than the scheduled rents plus other income less your vacancy allowance equals your effective gross income. Thank you very much.